Hello everyone and welcome to today's video. In today's video, we are going to take a look at the Finviz stock screener settings for swing trading. So for those of you who are new to swing trading is a type of trading where a trader usually enters the trade and then holds it for a couple of days. Usually the range of this would be from more than 1 day. So this is not an intraday trade to maybe 2 weeks, 3 weeks, 4 weeks. It can even go to up to 2 months. But then after beyond that, it starts becoming a long-term trade. So swing trading is something which a lot of people try to do because it's neither as aggressive as day trading, that you have to be glued to your computer screen and you have to execute multiple trades within the same day, nor is it something which is so passive that you don't have any action. A lot of people just cannot wait for the returns to come up or the trades to make sense for months together. They want to basically see the returns coming in within a couple of days, maybe a couple of weeks. So swing trading is ideal for that balance. And in today's video, we are going to look at a free stock screener, which is Finviz, and we'll see the settings which will enable us to execute and identify the trading opportunities for swing trades. Before we proceed, a quick look at the disclaimer, which basically states that any information that I'm sharing with you is only for entertainment purposes. It is not any kind of trading or investment advice. In case you want to trade or invest your money, please get in touch with a certified financial advisor. So basically, we will not waste too much of time because there's not too much theory to be explained here. I'll explain the various settings that I'm doing on the screener itself while I'm executing those settings. But in general, we are going to do five uh, types of settings on the screener. First thing is we don't want to work with stocks which are fundamentally not good. Okay, so we want to identify companies which are fundamentally good, because even with swing trading, although this is short-term trading, it is always good to be on the right side of things, so that even if you're executing the trade, you're not executing trades on fundamentally bad companies, right? So we are going to look at some of the fundamental settings, and we'll look at the trading framework settings. These are basic settings. If you've watched my other videos, these are basic settings which are basically to filter out all kinds of not so good companies, and we'll have a look at these as well. This basically takes care of the basics, like we want to have enough liquidity, we don't want to be looking at very small companies and other things. So that will be covered under the framework settings. Then we have technical settings. So we will be using one very important technical setting which is going to help us understand that we are buying the stocks at the right price. So we'll have a look at that as well. And if you've seen my other videos, I always propose that trading should be done using options. And I don't imply that you should use complex or very exotic option strategies. I basically use options to my advantage by using very simple option strategies. And so we are also going to enable this setting so that whatever stocks we are selecting in our screener, they have options. So you can do both the things. You can trade with the stocks directly as well, or you can use options, because we will just be using the filter to enable the output to show only those stocks which have option chains available. Okay, and then we don't want to be against the market. Okay, so the analysts in the market from various companies, from various hedge funds, investment banks, they continuously give out ratings on the various stocks. So we are not just going by the analyst ratings, we are doing our analysis, we are doing our technical settings, we are doing our fundamental settings on the filter, but at the same time we want to be aligned with what the overall market is doing. We don't want to go against them, so we will see those settings as well. So now let's quickly jump to the Finviz platform itself, and I'll explain the various settings that I'm doing, and we'll see what output we get for today's stocks. So this is the Finviz trading platform. The site is finviz.com. I'll leave a link to this in case you're new to the platform in the description, so that you can go here. And this has a free version as well as the paid version. For the settings that I'm going to do today, you can do it on the free version itself. But if you want to have more flexibility, you can go in for the paid version. And I'll leave the links in the description. I have a complete tutorial on how to use Finviz, how to navigate around Finviz in case you're new to it. So I'll leave a link to that video as well. You can check it out. And if you're interested, then you can go for the what they call the elite version as well. So once you're on this platform, you basically go and click here on the screener tab, and here you will be given these settings. Now, the overall filters here or the settings here are divided into multiple groups, but I like to go to all because with all, what happens is whatever settings are there under descriptive, fundamental, or technical, everything gets displayed here. So I can do all the settings in one go. So the first thing, if you remember, that we had on the slides was the framework setting. Now, framework essentially means that there are some basic settings which are applied to every kind of trading strategy. So whether I'm trying to build a strategy for swing trading or uh, to identify the fundamentally good stocks or simply some kind of a technical setup, these settings are a must. And so first, let's get started with those. The first setting that I'm going to do is the country. So I want to work only with stocks which have their headquarters in the USA or companies which are registered in the USA. And the reason is very simple. Uh, if you try to explore other markets, then you need to know what's going on in those economies as well. And right now, China is like, for example, under a crackdown on a lot of industries. So I basically don't want to venture into any companies outside of the USA. So this is something, a setting which you can change from time to time depending on the global outlook that you have. If, for example, you feel that Brazil is doing really well and you want to find out some good stocks which are trading on the US stock exchanges but are natively Brazilian companies, you can do the settings here. But for now, I'm going to restrict myself to only US companies. So that's the first setting I have done. The second very important setting is we don't want to work with illiquid stocks. So we want to make sure that the average volume on a daily basis is at least 100,000 shares. So this basically reduces our overall universe to stocks which are liquid. We don't want to run into liquidity issues. And if you see here, the total number of stocks that are coming in the output, this number is reducing continuously. So as I keep putting more and more filters, only those stocks which satisfy all these criteria are going to get listed. The remaining stocks will get filtered out. So the next setting I'm going to do is the market cap, which is going to be over $300 million. So that will be plus small over 300 million. So now with this setting, what I'm doing is I'm filtering out very small companies. Very small companies which have very small market caps, they tend to have a very volatile price most of the times. Reason is because if a small investment, I should not say a small investment, but let's say a company is worth $100 million and a 10 million investment comes in a single day or 2 days, the price is actually going to shoot up. Why? Because the market cap of the company is so small that even a 10 million investment is going to be huge for that company. So we don't want to work with that kind of volatile stocks. We want companies to be large enough so that their stock price is relatively stable. And another thing is that companies which have very small market caps usually have very low amount of cash available with them, and that can basically result them going into liquidity or solvency issues uh, in case they run into any kind of crisis. So we don't want to work with very small companies. We want to work with companies which are big enough that they have enough amount of cash with them, and also that their price is not super volatile. So this is the framework setting that you need to do. And the framework setting is basically just filtering out stocks, and this is a kind of setting that I do almost for every screener because I don't want to work with stocks which don't satisfy these criteria. Now let's do the second set of settings in which we are going to basically align ourselves with the market analysts. So there are two settings that I will do for that. The first thing that I want to do is I want to only look at companies which have not reached their target price, which has been set by the analyst. So for that, I'm going to go to target price and say above price. So what that means is that the target price for the company which is set by the analyst is above the current price. So there is a scope for the stock to go up. And remember one thing, that the same company is actually reviewed by multiple analysts. So this is the average price that is set by the various analysts who are analyzing that company. So what we are basically doing with this setting is we are picking up stocks, only those stocks where the stock price is still below the average target price set by the analyst. Also remember one thing, that this target price is not the price which the stock should reach immediately or today or tomorrow. It's the price which the analysts believe the stock should reach in 12 months from now. So the target price always is the price, I shouldn't say always, it's usually the price which the analysts believe that the stock would reach in the next 12 months. So we are looking at stocks which still have to reach their target price as per the analyst recommendations. With this settings, we're basically ensuring that we're not going against the analyst, because if a stock has already crossed that price, let's say the analyst put a target price of $120, but the stock is already trading at $200, then as per the analyst recommendations, the stock is already overpriced. We don't want to pick up those bets. We want to basically pick up stocks which still have a positive recommendation. That means these stocks still have a potential to go up as per the analyst recommendations. The second setting for the analyst would be the analyst recommendation, which would be buy or better. So this setting basically ensures that whatever stocks you are picking up, the overall market analysts have a buy or better rating. So it's going to be a buy rating or a strong buy rating for that stock, which basically means we are filtering out stocks which have a hold rating, which have a sell or a strong sell rating. Now, this is something which you can tweak to a certain extent. So sometimes you can use a hold or better, because a hold is a position which is not necessarily negative. So the analysts are not saying that this stock should be sold. They are just not giving you a buy or a strong buy recommendation. So I would leave this to be tweaked by the individual people who are trying to use the screener. You can do hold or better, you can do buy or better. Both the things, buy or better would give you lesser number of stocks, hold or better would give you more number of stocks. But essentially, we're trying to make sure we don't go against the analyst. The entire criteria of this filter, of this screener, is not that we want to work with analyst recommendations only. We just don't want to be going against them. So we have done the analyst settings as well here. Now let's go to the only technical setting that we're going to do, which is basically going to be uh, the RSI setting, which is oversold 40. So what this setting basically does is it is going to show us stocks which are not trading at their highs. And I'll quickly show you a couple of charts here. If you hover, you can see the charts, and in those charts you're basically able to see that all these stocks are recently having a dip. So let me otherwise go to the charts. And in this case, we can see that all these charts have a recent dip, and this recent dip is coming up because we have selected this oversold as 40. So this ensures that we are not buying at the highs. So the only way to make money in the stock market is to buy at lows and sell at highs. And I am a firm believer that if you buy at the highs with the anticipation or the expectation that the stock is going to form a new high, then that is not trading. You're basically gambling. You're putting a bet that something which is already trading at a high will go even higher. For me, I want to see things trading at a discount, and this is the rule that most people use in their day-to-day lives. We don't go out and buy a phone or any other commodity, a jacket, or anything that we want to buy at a premium. We look for discounts, we look for sales, and then we purchase it. But when it comes to stock markets, people have a very different perception. Already something which is at a high is in a huge demand because people really feel that this is going to go higher. So I don't believe in that concept. I believe in the stock taking a retracement, having strong fundamentals, so that it still has the steam to go up, but then I'm not already buying at the highs. So with this setting, we ensure that we are not buying at the highs. So I'll go back to the overview. So here we are at the overview, and we've done some of the settings here we've already seen. So now let's continue and do the fundamental settings also. So fundamentally, the first thing that, if you've seen my other videos, and I have a complete video on return on assets and its importance, the first thing that I want to do is I want to see the ROA to be more than 10%. Now, what ROA more than 10% basically does is it gives you, ROA is nothing but the return that you can expect on your investment, because assets are the ownerships or things owned by a company that can be used by the company for its operations. So anything and everything that the company owns is an asset for the company. And ROA basically means how much returns the company is able to generate given its assets. So if the company is given an asset of $1 million and they generate a 10% ROA, then that means on that $1 million, they're able to generate $100,000 in return. So that is a very key measure, a very important measure. And I use ROA because it is more conservative than ROE, which doesn't take account into debt. So for me, ROA has to be more than 10%. And the reason is very simple. If a company is not generating a return of even 10% on its uh, assets, then it is better to find an alternate investment which is much safer. Now, stocks are riskier than treasury bills, for example. If I can invest in treasury bills and get a 4% return, which is a much more higher probability return, if I want to invest in stocks, I want to see a premium being paid back to me, right? So ROA, if I search for ROA which is greater than 10%, it can fluctuate a bit. which basically means I'll get a return much better than the treasury yield. So ROA is reflecting the return generated by a company on its assets, and I want it to be more than 10%. Besides this, now I'll do two more settings, which are basically going to be EPS growth for the past 5 years, and I will put this as over 5%, and I'm going to put the sales growth over past 5 years also over 5%. Now, why am I doing these two settings? Let me first explain the sales growth over past 5 years. So we want the ROA to be above 10%, but we also want that the returns generated by the company should come from their core operations. And the core operations of a company is nothing but selling whatever product or service they are creating. So we want to see an increase in the sales. And once the sales growth is there, that means that the operations of the company are still growing. The product or service of the company is still in demand. So this is a company which is fundamentally doing well. Once you have the sales growth over past 5 years as over 5%, why do we need the EPS growth to be over 5%? Now, sales for a company can grow, but along with sales, if the costs also keep going up and they go up more than the sales or more than the revenue that the company is bringing in, then the earnings are going to still go down. So EPS basically means that you just don't have increment in the top line, but you have an increment in the bottom line as well, because we want to make sure that the company is net profitable, and that is ensured by the fact that the EPS is growing for the past 5 years. Another thing to note is that sometimes the company is generating net income, but what happens is the EPS will keep going down because the company issues more and more stocks. We don't want to invest in companies where the investors are being diluted. Imagine a company had 1 million shares and you bought certain shares of that company. So you had a 5% ownership of the company. Most retail traders would not have this kind of ownership, but I'm using this example just to explain. And now you've not done anything, but the company issues one more set of million shares. If that happens, then in that case, what is going to happen is now total shares which are there in the market have become double all of a sudden. So, for no fault of the investor, the ownership reduces to 2.5%, right? So, this is called dilution. And we do not want to invest in companies where the shareholders are getting diluted. So, this particular setting, EPS, EPS will not grow even if earnings are going up. EPS will not grow if the shareholders are being diluted. So in this particular case, with this setting, we are basically ensuring that although the earnings are going up, the shareholders are not getting diluted at the same time. EPS will go up only if both the things are satisfied. That is, earnings are going up as well as the shareholders are not getting diluted. So we have done the fundamental settings as well, and now you can see that we are down to only 18 stocks. So now if you just think about all the settings that we have done till now, we have done the framework settings, we have done the technical setting, we have done the fundamental settings, we've done the let's do the option setting as well. So I can put this to optionable. So now only stocks which have option chains will be listed here. So all 18 that stocks that we got till now have option chains. So basically you're not restricted to just buying or selling shares on these companies. You can trade in options as well because these have option chains. And because we have gone over with the average volume above 100k, so what is going to happen is there is a very good chance that these option chains are going to be liquid as well. So you can right now see the names which are coming up, which is Adobe and Etsy and a lot of companies which are very very popular. These are big companies, so definitely they have very active option chains, so you can execute option trades on these as well. So totally, if you see now, till now we have done 1 2 3 4 5 6 7 8 9 and 10 settings, and with these 10 settings itself, you can see that we are coming up with a pretty good output that we can use to execute the swing trades. For the fundamentals, now I want to do one more setting. So we have filtered out companies which are fundamentally good, right? They have a good return on assets. They have been doing well for the past 5 years in terms of sales as well as earnings per share. But then I don't want to buy these companies which are expensive. I want to buy companies which are cheap. So for that, I'm going to go and select PE and I'm going to say under 25. So price to earnings ratio is basically something which tells you how expensive a company is, and we do not want to buy companies which have a high P to E ratio. High P to E ratio means that the price of the company relative to its earnings is high. So imagine a company which is trading at a 200 P to E. That means the company is priced way expensive as compared to its earnings than a company which has a P2E less than 25, right? So with this setting, we are basically making sure that we are not getting into expensive companies. So if you see here, I have a lot of emphasis on buying low and selling high. I want to buy things at a sale or at a discount. Fundamentally, P2E is helping us to identify companies which are inexpensive, and technically, the oversold setting is helping us identify companies which are trading at a discount. So now you can see that in the output, we are coming up with four companies. And what are these four companies basically telling us? These four companies are fundamentally good companies which have good ROA, good sales growth, good earnings per share growth, and they are inexpensive. Technically, they are not trading at their highs. They've had recent dips because these are oversold right now. They satisfy the framework criteria, so they are liquid companies. They are US companies, and we are not looking at very small companies which can have very high volatile prices or have very, very low cash balances and run into solvency issues. And at the same time, these companies are having option chains, so if you want, you can trade options in case you are not interested in directly trading stocks. So this particular swing trading filter is basically giving you the best of the lot, technically, fundamentally, and also with the other basic criteria that we usually want to see the companies satisfying. And one thing that I want to call out is that these filter settings are just suggestive. These percentages, you can actually play around with them depending on the kind of market conditions. And I'll just explain this with one example. Now, consider the fact that the market has had a recent crash and the crash has been like 30-40%. So these settings may not yield too many results. And uh, uh, the thing may be that in that case, for example, when COVID happened, right? Obviously, the EPS may drop down below 5% or the sales growth may drop down. So based on the market conditions, you can actually tweak the settings to get the right kind of results. Same way, if the market is in a big boom, right, the prices are going very, very high, then if you have P2E under 25, you may not get much results. You may not get any results at all. In that case, you can simply modify this to under 30, because understand, when the overall market is expensive, if you're trying to find a trading opportunity, the most of the companies, if they are above 25 PE, you will not get anything in the results. So in boom times, I would basically go and tweak the setting to something above maybe 30, and then you can see extra companies getting listed here. So some of the settings here can be tweaked. For example, I already explained that I'm looking at the US stocks right now. If you think there is a huge potential in Chinese stocks or Brazilian stocks or stocks in Europe somewhere, you can accordingly tweak the filter. My idea here is to give you my screener settings that I basically deploy on a day-to-day basis. This is definitely something that I look at because this screener is not the holy grail, but it comes close to that. It's giving you stocks which are fundamentally good, technically set up, stocks which have option chains, stocks which are having good recommendations from the analysts. So the market has a good sentiment about these stocks. So everything is positive about these trades. And then using this filter, it forms a very, very important step or an input to the overall trading strategy. And combining this thing with option trades or money management rules, you can come up with a very, very strong and powerful and profitable trading strategy. So we just took a look at all these settings, and I hope that you understand the importance that a screener or a filter is not going to be helpful if you just look at one parameter. A lot of people just try to trade the stocks based on them being oversold, and RSI is a very, very important and a very, very popular technical indicator that people use. But this is what I keep saying again and again, that if I have a complete video and I have a playlist around RSI, so I'll leave a link to that in the description, you can watch that. But if you trade only using the RSI, you're not going to be profitable, in my opinion. So RSI itself is an important tool, but in itself it cannot form a complete trading strategy. If you want to look at a complete trading strategy, it has to be combined with other things, and that basically makes your trades profitable. I hope this video was useful and you've learned something and you will apply this to your trading. So let me know your feedback in the comments, and if you're planning to deploy this particular screener in your trading, and any comments or any questions that you have are most welcome. So please share this with your family and friends if you find this information useful. Like the video and subscribe to the channel if you've not already done so. And I'll catch you guys in the next video. Thank you for your time.